Good afternoon. We're NewDeal Real Estate, representing Oakwood Real Estate Debt Strategies today. Before we get started, we'll just briefly introduce you to the team. This is Adam, Ian, Herbert, Nicole, Oded, and I'm Ryan. Just a quick recap of the fund. Oakwood Debt Strategies, $300 million fund, of which we have $150 million of dry powder remaining to deploy up until June 2019. It's investable life through June 22 with a one-year option. We're targeting 9+% returns. We have a quality bias focused on relative value through short-term floating rate originations. So today, we're going to run you through situation overview as it relates to Kenwood Center. We're going to step back, lay out the macro fundamentals, and then we'll dive into the asset, and then show you the situation that we're dealing with, how we went about it, the investment analysis, the recommendation, and then we'll also talk about how we can continue to invest in this space going forward. Just as a quick high level for you, we do recommend our own loan modification counterproposal that not only achieves the fund's targets, but also significantly reduces risk in the asset. So in June 2015, we originated $20 million of mezz debt, which was an 80% LTV, implying a $75 million property value. Essentially, on day one, the equity was wiped out, which skyrocketed the LTV north of 95%. Fast forward to 2017, we now have annual NOI of $4.1 million, which is insufficient to cover the debt service. And that NOI is declining into 2018. With that, I'll hand it over to Adam for the retail environment.
Thank you, Ryan. Before we go into the specifics of the Kenwood property, I'd like to give a broad overview of both the economy as well as the retail landscape. The U.S. economy is healthy and it's growing. GDP increased by 3% last quarter, and the unemployment rate continues to decrease, currently at about 4.4%. The median household income has remained relatively flat over the last 20 years, and as average income rises, what that means is that most of the gains are going to the upper class. Consumer retail spend continues to grow as well. It's projected that there will be $5.13 trillion spent by the end of this year. So we're looking at an environment where retail spend is increasing, and the higher income segments are what's most attractive. E-commerce continues to pressure brick and mortar retail, but I think it's important to note that brick and mortar retains the lion's share of that consumer spend. At the end of 2016, brick and mortar still made up for 90% of total consumer spend at about $4.6 trillion. E-commerce continuing to push pressure on the brick and mortar segment, and you'll see that more going forward as e-commerce captures 2/3 of the forward growth. But that means brick and mortar is continuing to grow with 1/3 of the remaining growth. Consumer preferences are changing. 68% of consumers prefer purchasing their electronics online as well as their books. But what's also important to note is that traditional e-commerce, pure e-commerce plays are embracing brick and mortar retail. For example, Amazon alone made $1.3 billion from their brick and mortar stores last year.
Thank you. Adam just laid out a fairly complex picture in which current brick and mortar retail dominance and market share is contrasted with growing turbulence in retail as e-commerce exerts pressure on all players. That's naturally going to play into the outlook for our particular asset class. Nationally, you see vacancy rates hovering around 5% for power centers. Supply remains fairly constricted, with only 5% of total retail square feet under construction as of Q1 2017 consisting of power center space. However, we should note that we did witness a 61 basis point increase year over year in the first quarter for vacancies in power centers associated with 1 million square feet of negative absorption, suggesting that there is limited market appetite for what new supply is coming online currently. Stepping back, these statistics could be seen, taken together, to endorse the view that retail should be avoided at all costs. However, we do think that thinking that way would overlook strong evidence that select properties can in fact outperform these dynamics. Cushman & Wakefield has observed that power centers in the Class A and new construction are disproportionately grabbing growing retailers, and as a consequence, they're forecasting increasing rents for Class A properties even as Class B and Class C facilities suffer declines in their pricing power. Moreover, grocery-anchored centers have been observed to have absorption rates about 3 times the overall average, indicating that tenant mix is a critical determinant for outperformance moving forward. So just who are these tenants who are going to be moving into these centers? Even in a year, 2017, where we have a record amount of retail square feet coming back into the market as a result of store closures, we are seeing evidence that individual retailers are growing increasingly resilient to e-commerce penetration and adapting to the new retail environment. TJ Maxx and Ross, two examples of off-price retailers, are planning on expanding to 310 new locations in 2017 on the back of strong demand from high-income shoppers and price-conscious individuals. Furthermore, grocer Aldi is forecasting 900 additional stores over the next 5 years. Beauty retailer Ulta is capitalizing on a fragmented market for beauty products, as well as an experiential mode associated with their beauty salon services to drive 100 new store openings in 2017, as well as increasing operating margins and sales per square feet. What we are seeing here holistically is creative destruction in physical retail, not its demise. We believe that micro-stories can insulate retail landlords from the turbulence in the broader market. And as a consequence, landlords holding quality properties located in dense areas with excellent demographics and a strong foundation of resilient key tenants can expect to attract the new winners in retail and outperform their peers going forward. Herbert?
Great. Thanks, Ian. So, as we started to take all this data around market influences and put it within the context of retail capital markets, we see that there's been overall, very broadly, a depression in market and transaction volume year over year. But focusing specifically on power centers, we see that there's been an increase in transaction volume. Given this information, what it led us to believe is that investors are seeking value, even though the headlines may be very negative and investor sentiment across the entire sector is depressed. The centers that have more defensive type of tenants, and again, they're positioned well within their market, can provide a very attractive risk-adjusted returns. And that micro story about what specifically is going on the ground around these centers and not just the broad headlines is how we kind of drilled in and focused on our specific asset, Kenwood. We love the market. We thought that very dense, favorable demographics, highly educated workforce and population, and it's experienced a lot of growth since the last cycle. And furthermore, this growth is projected to continue as jobs in the energy and healthcare sector continue to grow as well. From a supply standpoint, again, this dense market where it has high barriers to entry, and we're not seeing, we viewed that as somewhat defensive against potential supply coming online that would somewhat suck away the tenant demand. And the tenants that are already at that center, we see some of these names have already been touched on, Ulta, Home Goods, et cetera. Some of the names that are more defensive against some of the disruption that's going on in the e-commerce sector. So to sum it all up, we like where this asset is, and although we do have concerns about what's going on specifically with Toys R Us, we felt that there was a very strong foundation to position this asset potentially moving forward.
All right, thank you, Herbert. So given that backdrop, I'm going to go through and go through our investment recommendation and rationale. So we recommend accepting MacArthur's modification, but subject to additional terms. As a debt lender, we're ultimately concerned about mitigating our loss in a downside scenario and limiting our loss in the event of a default. Specifically, we would look at sponsor quality, stability of cash flows, and asset value. To mitigate some of these risks, we propose the following terms. So first, we're going to request that the sponsor put up additional collateral. Currently, there are out parcels of land that are unencumbered. They have a value of $5 million. So we're going to ask the sponsor put those up as collateral for the mezzanine debt. As it stands today, the sponsor only has $3 million of equity in the deal, and we simply do not think that's enough skin in the game to compel him in a way that adds value to the property and work towards leasing up that asset. Also, in a downside scenario, if the property does go into default, having claim to this collateral significantly increases our claim. Second, we're going to accept Toys R Us's reduced rent proposal of $7 a square foot, but we're going to limit their lease term to 5 years versus the standard 10 years. So the reason for doing this is that when we look to exit the property in 3 years. We don't want future buyers to be deterred by having a long-term lease in place with a large tenant like Toys R Us at significantly below market value. We're also going to put in a unilateral right to vacate with 6 months' notice so we can exit the lease as we wish. For fees, we're going to impose a 1% fee on the additional $6 million of capital that MacArthur has requested. The rationale here is that we charged an origination fee of 1% on the original $20 million loan. So had MacArthur asked for $26 million from the beginning, they would have had to pay 1% on this incremental fee anyways. The fourth term we have is we acknowledge that MacArthur has requested up to $6 million of additional capital, which we're prepared to give them. We're going to fund the initial $2 million right away, and that's for budgeted CapEx in 2018. But the remaining $4 million we're going to disperse over the life of the loan and tie those disbursements to revenue-generating activities. So MacArthur will get those funds during the lease-up period. So given these terms, we have an expected IRR of 9.6%. This is in line with our fund mandate, and it's comparable to the returns under the sponsor's proposed modification. We did address some additional risks with this asset. So one of those is additional tenant bankruptcy or vacancy. There is a risk that if Toys R Us were to vacate, there are some co-tenancy agreements, and we recognize there's a lot of value to be lost should Toys R Us vacate and we are unable to fill the space. Other tenants may leave as well, so we want to keep those tenants in place, which is one of the reasons why we granted the reduced rent. Next is a risk that we're not able to fill the vacancies. So as it stands today, we're 75% leased, but we've taken a good look at our asset and we think there's tremendous opportunity to attract a relevant and stable tenant base. And this would lead to stable cash flows, which is something we look for as a lender. We did some more analysis on the lease-up, which Oded will speak to in a bit, but more to come there. Another risk in the real estate market is oversupply. So this could severely impact our asset value. But as Herbert mentioned, Kenwood is in a neighborhood with high barriers to entry, so we think there's limited risk of oversupply here. Another risk is default following additional funding. So in the event that we do grant MacArthur all $6 million of the capital that they've requested, there's a risk that they still default on the loan. To mitigate this, we've asked for additional collateral. We've tied the loan disbursements to revenue-generating activities. So those are some safeguards we've put in place there. Lastly, there's the issue of moral hazard. So this risk is probably the most difficult to quantify, but we did spend a good amount of time analyzing this. As Ryan mentioned, the capital structure today, the sponsor only has $3 million of equity in the deal. We don't think this is enough to compel the sponsor to act in a way that adds value to the property and sees it to its full potential. So we want to increase his stake in the deal in order to have him act in a way that generates value for our asset. So again, that's increasing the collateral, increasing his stake in the deal. Also, extending the loan term to 2020 has the sponsor act and take a longer-term view of the investment.
Perfect. Thank you, Nicole. So we discussed earlier the leasing strategy going forward. We understand that MacArthur is the operator on the ground. He has the local relationships and the know-how. Having said that, we're looking to have more of a hands-on approach going forward with regards to the lease-up. And in line with what my colleagues detailed, we're looking to have more of a diverse tenant base, robust, and that will sort of be resilient to the e-commerce trends. So that goes to grocery stores, it goes to entertainment, restaurants, and experiential such as Alamo or REI. Now, the interesting thing is that if you drill down to the top retailers in these categories, the things that they look for are applicable to our property. So as far as vacancy size, access to high-income population, highly educated population, parking spots, etc., we offer what these retailers are looking for, and we think this provides a win-win situation for us. Now, We're very comfortable with the solution that we proposed and with the strategy that we propose going forward. Having said that, we did assess different alternatives, various alternatives that we found less compelling. The first alternative that we assessed was basically a foreclosure on the asset right now and selling it with the forward-looking NOI of $3.5 million and an in-place cap rate of 6%. We basically are able to recover less than 100% of our loan. Another alternative that we looked at was immediate foreclosure, refinance of the, pay back the senior debt and become basically equity investors in the property. This would result in a very risky position that we put ourselves in a distressed asset, and it doesn't align with our fund's mandate. It doesn't align with what we promised our investors as debt investors. And finally, the third alternative that we examined that we found less compelling was basically taking the sponsor modified loan as is, so his revised terms as is. And as we've sort of detailed throughout the presentation, we found that less compelling from a risk adjusted basis, where we feel that the moral hazard risk and the minimum amount of equity that he puts in and the time horizon of his investments, they just don't align to us, and it exposes us to significant risk. With that, I'll pass it back to Ryan.
Thanks, Oded. So this experience lending to MacArthur really made us take a step back and think if we could continue to participate in this space. And we definitely think we can. We're attracted to the right type of retail. And so going forward, we want to ensure that we meet three main objectives when lending in this space. One is ensuring a disciplined and systematic approach to loan terms and covenant packages. That means really putting guardrails on what capital can be used for. The second is sponsor quality, focusing on borrowers with strong capital reserves and a long-term outlook on the real estate markets that they're investing in. Third, and this is specific to retail, we want to be very picky about the assets that we invest in. High income, high density, highly educated populations, a diverse tenant mix that is not only resilient to e-commerce, but those retailers who are able to evolve with the retail landscape. In conclusion, in 2015, we originated $20 million of mezz debt. The equity was nearly all wiped out. The asset was underinvested, and we find ourselves today needing $6 million to get the asset back to stabilization. We found a solution that not only recovers our principal as opposed to a foreclosure, but it meets our fund objectives, and it significantly reduces the risk that we have in the asset by incentivizing the landlord and limiting his moral hazard. At this time, if there are any questions, we'll be happy to answer them.
What's your backup plan if you don't get the outparcels?
I think that's a good question. We certainly want to work with the sponsor to make this a successful project, but I think probably the more important question is why wouldn't the sponsor want to be invested in this with us as a partner? So we've got a Class A asset with high barriers to entry. What is it that this person's unwilling to partner about? I mean, frankly, if we aren't able to get any sort of additional equity through those out parcels, then this isn't really a partner at all. And you want to talk about risk. It skyrockets. At that point, our hands are bound because we're not in the position to be 100% equity owner given the mandate of our debt fund. Our hands would be bound and we'd need to foreclose on this partner. But we really think that it's a workable solution to bring in the equity. Go ahead.
Is there a market for, I presume you're going to get the project stabilized once the 52,000 square feet gets leased and you sort out some of the other lease terms. Is there a market for that kind of structure to sell at the 6 cap or whatever you're shooting for on an exit?
You're speaking specifically to the 52,000 square feet?
No, the whole power center, when you sell to get your money back at the end, or when your sponsor sells at the end of the day to get your money back. Is there a robust market to buy this kind of asset, or are people only investing in ones that are value add type things that have some short-term leasing risk and more upside for the buyer?
I think what we're seeing across the sector is that there is for the right types of assets. So I think it's very difficult to say, broadly speaking, but I think there was some commentary around Class B and C centers that are witnessing the least amount of activity. But for the Class A centers that are well located, again, in these markets that are highly desirable with a tenant mix that makes sense, we do find comfort that there's going to be liquidity on the back end as we're looking at exits moving forward.
How did you think about your negotiations with Toys R Us? Mainly, why did you think you had leverage over them, versus them having leverage over you? And then what if they didn't accept the shorter term?
That's a good question. So really, the fact of the matter is whether Toys R Us is in a situation where they need to generate as much revenue as they can, I think it would be almost, for lack of a better word, silly to think that they were obviously not going to take new space somewhere else. They have an operation going. This significantly reduces their rent. To limit it to 5 terms, I think that was something that we wanted to put in place. If you think about it from the other perspective, it's much better locking them in for at least 5 years as opposed to saying, okay, leave, and then we're out another $260,000 in NOI in 2018.
So would you, the other part of my question is, would you let them, if you didn't come to a resolution, you could just allow them to leave?
I think we'd be really hard pressed to let that happen. We're already at 25% vacancy. The last thing we want is a death spiral.
Can you clarify, you said if you don't get the out parcels, you foreclose. Would you foreclose and sell, or would you foreclose and reposition?
Foreclose and sell.
Yeah.
Foreclose and sell. Ideally, we would, if the sponsor comes back with this notion of, have some uncomfort with giving the out parcels, all of them, there's an opportunity there to say we'll have, we would definitely be willing to try to find some types of alternatives. But I think the main point being that if this is a situation where they're unwilling to do, frankly, there was already been some statements about no cash, which that would be ideal. So we feel like the out parcels is a good solution potentially to kind of meet in the middle. So I guess that's how we would view it moving forward.
I think just to piggyback on Herbert's point, the biggest value of the project sponsor is they are the local operator, they're the local knowledge with the experience. It doesn't make a whole lot of sense for us to take over the asset and try to reposition it. There's no way that we can come in and try to replicate what we've identified a stronger partner to do for us.
So you would give on the parcels?
If we would try, if we're going to stay in the deal altogether, we need to increase the sponsor's equity in the game. So the full $5 million of the out parcels is what we would be looking for. If there is some wiggle room in there, then that's fine. But at no additional equity, then that's a non-starter for us.
If the sponsor is so hesitant to give us additional collateral, we would also ask the question, why are they so hesitant? Do they know something about this asset that we don't know, and we think that's a negative signal, which, would leave us no choice but to foreclose and sell.
Exactly.
Somewhere else, right? Well, you might not have that option.
They're unencumbered.
Yeah, they're unencumbered. It mentions, yes.
Yeah.
Yeah.
Clarification on your structure. So the structure, other than getting more collateral, is for the extra fundings, you can get paid L+4 on a cash basis for your past amount plus the new funding, and you're going to accrue 4% until the very end on the total amount.
Yes.
That's right. Capitalizing the extra, yes.
Just want to make sure I understood right. You guys a couple of times said the sponsor only has $3 million of equity in it,
Yeah.
and then you said the project's worth $56 million today and you owe $60. So how does he have $3 million in it? Sounds to me like he's got negative equity.
Yeah, so what we were saying is that at 80% LTV in 2015, there's a $75 million property value. And then we're told that 20% of his equity stake is remaining after he buys out a partner and pays out some distributions. So of the 15 million, he's got 3 million left. That's today. If we sell on forward NOI, then you're right, there is negative equity in the deal in trying to sell at the end of the year.
We meant maybe the $3 million, just to clarify, is what cash he put up front that's left that he didn't pull out of the project. Obviously today, if the value, as we say, is $57 or $58 million and he has negative equity, but he initially put in 15, he took out 12, he's still invested, or for him it's a sunk cost, but he's still invested $3 million in it, which is what we mean with that $3 million.
Following up on, so the total return is 9.1. What do you expect about the new money? Because I wasn't trying to figure out your negative yield that you exposed today. You're going to get yourself back up to a 9% fund level target return. What's the new money getting?
So it's a 9.6 IRR on round trip cash flows. We initially give the extra $2 million plus the TIs and leasing commissions. They're staggered over the next 3 years. Did we have as far as the
I'm
new
not
money,
sure
it was
I
still under
understand
the
your
same.
question.
It was
So
under the
just on the
same
new
terms,
money,
but
how
there
much
was
on
an
it?
additional 1% fee.
How much on the new money, I guess?
It's just,
Yeah, so it's this, so you took an equity position. You're getting, is that an equity yield?
We capitalize that on the existing loan balance.
thank you very much.
Thank you.